Welcome to the Deep Dive, where we, cut through the noise to get you informed fast.
And today we're digging into Ultralife Corporation.
That's right, their second quarter 2025 results and the earnings call that followed. And look, just glancing at the headlines, it seems like a challenging quarter.
Yeah, that's fair to say. They missed analyst expectations, revenue, earnings.
And the stock took a pretty significant hit afterwards.
It did. But, when you look just a little deeper beyond those initial numbers.
Which is what we do here.
Exactly. There's quite a bit more going on, how different parts of the business performed, some external things hitting them, and management's strategy looking forward.
Some more nuance than just bad quarter.
Definitely. So we'll guide you through what happened, why it seems to have happened, and what the company is saying they'll do next.
Okay, let's start with those headline numbers then. Get the tough stuff out first. Consolidated revenue was $48.6 million for Q2.
Right, which sounds okay in isolation, maybe.
Okay.
It's up from $43 million last year.
But it actually missed the consensus estimate. Analysts were looking for closer to $51 million.
So a miss there. And that flowed down, naturally. GAAP earnings per share, just $1.05.
And the adjusted EPS, which is often what the market focuses on, was 0.7 cents.
Yeah, and the non-GAAP consensus was like $0.13. So quite a miss on earnings, too. Net profit overall, only $2.9 million.
We also saw operating income drop quite a bit, down to $2.3 million.
Which is down 41% from the same time last year, although last year had a one-time adjustment in there, to be fair.
Still a big drop. And the consolidated gross margin, that's a key one for profitability, fell 300 basis points. That's 3 full percentage points, down to 23.9%. Ouch.
From 26.9% a year ago. And even adjusted EBITDA, sort of a proxy for cash flow, that was down too. $4.1 million from $5.4 million.
Okay, so the numbers definitely paint that challenging picture you mentioned.
Yeah.
Clear headwinds.
No doubt about it. Not what investors wanted to see.
Let's talk about those margins specifically. Why the big drop? What did the company say was driving that?
Well, it wasn't just one single thing, which actually makes the quarter more interesting to unpack.
All right.
They pointed to a few main culprits. First off, an unfavorable product mix shift.
Meaning?
Basically, they sold less of their higher margin stuff and more of their lower margin products.
Ah, okay. So even if volume holds up, the profitability per sale goes down overall.
Precisely. Think like selling more basic batteries instead of complex medical power systems. That mix shift alone cost them almost 200 basis points of margin.
Wow. Nearly 2/3 of the drop just from what they sold.
Yeah. And on top of that, you had tariffs. Direct hit.
How much did that hurt?
Well, they paid out about $539,000 in tariffs. They did manage to get some back from customers, about $126,000.
Okay.
But that still left a net impact of around $400,000, and that chewed up another 100 basis points of margin.
And wasn't there something about timing with those tariffs?
Yeah, that was particularly painful for them. They said they're basically forced to buy some components right when those China tariffs were at their peak, just to get orders filled. Unfortunate timing, really.
Bad luck compounding the issue. What else?
They also mentioned some operational inefficiencies, things like writing off materials that weren't quite right, needing more overtime, just general labor inefficiencies.
How much did that add up to?
About another 30 to 40 basis points of margin impact, they figured. And then overall operating expenses were up 22.2%.
Why was that?
Partly because they now have the costs from the Electrochem acquisition fully included.
But
also, they significantly increased spending on new product development, up over 25%.
So dealing with current issues, but still spending on the future.
That's the balancing act, yeah.
Okay, so if we move beyond the overall numbers and the margin pressures, things get really interesting when you look at the different business segments, right?
Absolutely. It was very much a tale of two different stories there.
Let's start with battery and energy products. That's their biggest segment. Revenue was $45.9 million.
Correct. Which looks pretty good on the surface, up 25% compared to last year.
But there's a catch, isn't there?
There is. The kicker is, if you take out the recent Electrochem acquisition...
And then they bought last year.
Right. If you exclude that, the organic sales for this segment were basically flat year over year.
So almost all that growth came from just adding Electrochem's revenue.
Yeah.
Not from their existing lines growing much.
Exactly. Now, within that segment, there was a bright spot. Demand from a big U.S. government defense contractor, what they call a global prime customer, was really strong.
Okay.
That pushed their government defense sales up over 61%. So defense became a much bigger piece of their pie.
But what about the commercial side of that segment?
That's where the weakness was. Commercial sales actually decreased by over 20%.
Oof. What drove that?
Medical battery sales were down almost 39%, which they said was mainly due to order timing. And oil and gas sales dropped about 23%, blamed on, wider economic and geopolitical factors impacting that industry.
So strong defense holding things up, but significant weakness in medical and oil and gas within the battery segment.
A real mixed bag there.
And now the other segment, communication systems, that had an even tougher time.
Oh, definitely. Revenue there fell off a cliff, really. Down 57.2% to just $2.7 million.
Wow. From $6.3 million last year. Why such a dramatic drop?
Two main reasons cited. One, they had some large shipments in the same quarter last year that just didn't repeat this year.
Okay, tough comparison.
And two, they had delays on about $2.7 million worth of purchase orders. Customers pushed those out, apparently into the second half of this year.
So a timing issue again, but a big one for that smaller segment.
A substantial one, yeah.
But here's something interesting you pointed out earlier. Despite that huge revenue drop in communication systems, the gross margin for that segment actually went up.
It did, yeah.
Yep.
Improved to 28.4%.
How does that work? Lower sales volume usually means lower margins because of fixed costs.
It's a bit counterintuitive, but they said it was due to a favorable sales mix within that segment. So even though they sold a lot less overall,
The things they did sell were higher margin products.
that seems to be the case. Maybe specialty amplifiers or specific power systems, something like that. Or perhaps they managed costs related to volume effectively. It's a small silver lining in that segment's performance.
Okay, so putting it all together, a mixed quarter, pressure on margins, segment divergence. What does this tell us about their strategy and what they're doing behind the scenes?
Well, despite the Q2 results, they've clearly been active. Integration of that Electrochem acquisition is a big focus.
How's that going?
Sounds like it's progressing. They finished the main system transition email, office software, and crucially, the ERP system in Q2.
That ERP is key, right?
Yeah.
For running the business efficiently.
Absolutely. Getting everyone on the same system is critical for synergies, faster product launches, all that. They expect the rest of the manufacturing support systems to transition in Q3.
So getting close to wrapping up the major integration pieces. Any one-time costs associated with that?
Yeah, there were some in Q2 related to finishing the ERP, and they expect some more in Q3 for the final manufacturing system. They also closed their Mississauga facility, consolidating things, which should cut future costs.
And they're looking at vertical integration, too, using Electrochem cells.
Right. Trying to incorporate Electrochem's battery cells into Ultralife's existing battery packs. That's more of a long-term thing, though.
Benefits when?
They're targeting benefits for oil and gas customers, specifically for things like pipeline inspection tools, seismic monitors, sonobuoys, starting in 2026.
So still a way off, but potentially significant down the road.
Exactly. But there was an immediate win from an operational project at Electrochem. A lean manufacturing project meant they avoided having to hire 30 extra people. So some tangible benefits already.
Good to see. What about the balance sheet? Debt?
They're actively managing that. They actually prepaid $2.7 million of the debt they took on for the acquisition back in Q2.
Where'd they get the cash for that?
They used the $1.8 million they received from the employee retention credit, that COVID-era tax credit,
Right.
plus the interest they got on it. So in the first half of this year alone, they've already paid down $3.4 million in principal on that debt.
Which is more than they were required to pay for the whole year.
Yeah, their full year requirement was $2.8 million. So they're ahead of schedule on debt reduction. Shows good liquidity management.
Okay, that's positive. And one last strategic point, that cyber attack from 2023. Any updates?
Yes, quite a significant one. They got a small insurance payout, $0.2 million in Q2 2024.
Okay.
But now they've actually filed a lawsuit against their insurance carrier.
Really? Why?
They're going after millions of dollars in damages they believe they're owed for business interruption caused by that ransomware attack.
Where is that lawsuit happening?
Supreme Court of Wayne County, New York, where Ultralife is based. They're planning for a jury trial around mid-2026. Management sounds pretty confident in their case.
Okay, so that's a potential wild card way down the line. Interesting. So, looking forward now, how is management framing the second half of 2025 and beyond?
Well, despite acknowledging Q2 was, I think the quote was, a very challenging quarter.
Yee, diplomatic.
They did express clear optimism for improvement in the back half of the year and into 2026.
What are they pinning those hopes on?
A few key things. They expect that communication systems segment to rebound as those delayed orders hopefully come through.
The $2.7 million that got pushed out.
Exactly. They're also seeing early orders for some new long-cycle battery programs, and they expect demand in medical and oil and gas to recover somewhat from the Q2 lows.
Seen signs of that already.
They mentioned seeing somewhat of a return in those areas for the second half, yeah. Plus, ongoing global defense spending remains a solid driver for them.
And getting those Electrochem synergies, the vertical integration.
Right, focusing on realizing those benefits. And they also talked about an expanding pipeline of opportunities across both businesses with better quality leads and bigger potential deal sizes.
You know, what really stood out from the call was the CEO's tone, Mike Manna. He sounded impatient.
Definitely. He explicitly said they're incredibly impatient for results. And he highlighted that insiders like management and the board own almost 40% of the company.
So they have serious skin in the game. Their own money is on the line.
Very much so. He framed it as they're playing for the big W, chasing multiple large opportunities.
How large?
He threw out numbers like $5 million to $20 million each potentially as adders to the business. The goal is to get past being what they called subscale.
Trying to break into the next level.
That seems to be the ambition. But they know it takes time.
And they're not just waiting. Right. They mentioned that increased R&D spending. What are they working on?
Quite a bit, actually. On the communication side, new rugged server cases, a new DC power supply for vehicles being tested now, a new 20-watt amplifier they think has a $5 million annual market potential, expecting initial orders this year. Also, a next-gen high-performance amplifier coming late 2025 for testing, and a production order for a new advanced speaker.
Busy on the comms R&D front. They're showcasing some of this soon.
Yeah, those new amplifiers are heading to a big defense show in London in September.
And on the battery and energy side.
Lots happening there, too. Getting initial production ready for their thin cell tech think medical wearables, industrial tracking aiming for revenue in 2026.
That sounds interesting.
Growing interest in their 123A battery line for things like flashlights, night vision, that nenyl fluoride tech we mentioned.
Right, for metering and long life stuff.
That's moving through customer qualification for 2026. They're also pre-releasing their newest X5 medical cart power bank with production later this year. And they got a new order for their conformal wearable battery from an international customer.
So, lots of irons in the fire on the product development front.
Definitely shows where that increased R&D money is going. They're betting on these new products to drive future growth.
Okay, so management is optimistic, investing in the future, dealing with current headwinds. How did the market react to all this news after the call?
Not well initially. As you mentioned, the stock dropped sharply. It fell 17% the day after the earnings release and call, closed at $6.77.
And trading volume was high.
Very high, yeah. Around 239,000 shares traded, way above average. Clear sign of investors reacting, mostly negatively.
So the market focused more on the current misses and margin pressure than the future optimism.
It seems that way. The immediate sentiment was definitely cautious. You know, the slump in communications, the overall miss versus estimates, the margin compression. Those seem to outweigh management's talk about the second half recovery and long-term plans.
It's a show me story now then.
Absolutely. For the stock to, regain trust and for that optimism to be validated, Q3 results are going to be really critical.
Investors want to see concrete proof. Better margins, those comms orders coming in.
Exactly. They need to show the strategy is translating into actual financial improvement. Any relief on tariffs would help too, of course.
Okay, so summing it all up, a really revealing quarter for Ultralife. Showed significant challenges, especially with margins and the comms business.
Definitely highlighted the headwinds, but it also gave us a look inside a company that's making pretty big bets on new products and integrating a major acquisition.
You can really feel that tension between the current struggles and the potential they see down the road.
Yeah, and management's impatience, that insider ownership, they're clearly pushing hard to land those bigger deals, those $5 to $20 million adders they talked about.
But these things take time, especially in defense and medical. And as Q2 showed, external factors can throw a wrench in the works pretty quickly.
That's the risk. So the big question for you, listening, to think about is, can this company, which calls itself subscale, actually pull off this transition?
Can they convert all this R&D spending and the acquisition into the kind of step change in revenue and profit they're aiming for, especially given how long some of these product cycles can be.
And what about that lawsuit? Could a multi-million-dollar win there in, say, 2026 be a game changer for them? It's definitely a company in transition. Fascinating to watch right now.
All right, before we wrap up, let's do our This Is Not Financial Advice segment. Given everything we've discussed, the subscale status, the tough quarter, management's impatience, the long-term bets, what's an outrageous but plausible idea?
Okay, so strictly hypothetical, for someone very adventurous, you could think about the potential catalysts here. Those big W opportunities, the lawsuit.
Right, the infrequent but potentially large events.
Exactly. So maybe, just maybe, you could consider something like a highly speculative, long-dated call option spread, say out to 2027, well out of the money.
Betting on what?
Betting that either one of those big product initiatives finally lands and causes a significant jump, or that the cyber attack lawsuit resolves very favorably for them in mid-2026, leading to a fundamental re-rating of the stock.
So a pure bet on low probability, high impact events for a small, impatient company.
Purely that. It's a bet on potential, not current performance.
Yeah.
Definitely do your own deep research. This is just thinking out loud based on their situation.
Absolutely. Okay, that's all for this deep dive into Ultralife Q2. Thanks for joining us.
Hope you feel a bit more informed now.
Until next time, keep digging for those insights.